Hello everyone, this is Rob McDougall with Zhang Financial here with your weekly economic update. Today is Monday, December 30th, 2024. So last week, of course, with the holiday, Christmas holiday, very short week, both in terms of the market and economic activity that was released. Of the economic activity that was released, it was mixed to slightly weak, which is probably not a bad thing since inflation is such a focus for investors at this time. So last Monday, in terms of economic activity that was released, building permits, durable goods, and durable goods ex-transportation, all three of those metrics fell slightly short of expectations. Building permits expected to come in at a little over 1.5 million, came in just under that, 1,493,000. Durable goods was expected to come in down 0.4% month over month for November, came in a negative 1.1, and durable goods ex-transportation, that was expected to be a positive 0.3% month over month in November, came in at a negative 0.1. So one economic data point from last week that was positive, new home sales, expected to come in at 650,000, came in at 664. Lastly, again, sparse week of economic data, but initial jobless claims came in better than expected. So the consensus was 224,000 new claims, came in at below that at 219,000. Wrap all that up, and how does that impact GDP expectations for the fourth quarter? Atlanta Federal Reserve says no change, still expecting a very solid, very robust, positive 3.1% GDP growth for the fourth quarter. Inflation expectations last week up just a little bit, up 5 basis points, up to 2.34%. Again, that's the built-in expectations of inflation, the average for the next 10 years. Fed funds expectations. So our next Fed fund meeting, which is in January, the FOMC meeting, the expectation is that we will not have any cut. We will not have a single cut. But the expectations dropped on that a little bit. So expectations modestly increasing that we might see a 25 basis point cut. But bottom line is almost 90%, 88.8% probability built into the futures market that we will not get another rate cut here in January. So markets last week, how did they respond to almost no economic news releases? Well, kind of meandered, but slightly up here in the U.S., and nicely for the S&P 500. S&P 500 up 70 basis points, 0.70. And on a year-to-date basis, here we are just a couple of days, 2 business days from the close of the year. As of the end of the week last week, S&P 500 up very impressive, 26.9% for the year. The NASDAQ has led that. NASDAQ up 31.4% over that time. Growth and large cap have beaten value and small for the year. Go back to last week. Growth actually sputtered a little bit, slightly negative. Value up about 80 basis points. But again, full year relationship growth up nearly 26%, 25.75. Value up 14.4. Large cap up a little over 30%. Small cap 11.6%. In terms of international markets last week, developed markets did beat the U.S. market based on the S&P 500, whereas emerging markets had kind of a rough week. Developed markets ex-U.S., solid week, up 1.63%, but for the full year, that metric or that index is up only 2.6% for the entire year. And again, we have the S&P 500 up 26.9%. So much better to be in U.S. equities versus international, which virtually every portfolio we manage is at this time. Last week, emerging markets down about 1%, and strangely enough, not led by China. China was up 1.2%. So the rest of emerging markets ex-China had a rough week, down, let's just call it 1.3%. Fixed income last week, another bad week for fixed income. U.S., the Bloomberg U.S. aggregate down 33 basis points. So for the year, The Bloomberg U.S. Aggregate Bond Index is up 93 basis points, and within the last certainly 10 weeks, at one point we commented on the fact that it had rallied so strongly that on a year-to-date basis, its return was up over 6%. Well, that's all come apart, and again last week gave up further ground, so it's going to end the year close to flat, up just a little bit. Last week, 2-year yield up 2 basis points, the 10-year up 11 basis points. And now we had talked about the yield curve inversion, which lasted nearly 800 days, and that relationship changed during the third quarter. Well, since that point, now we've actually got a further steepening of the yield curve. So now the difference between the 2 and the 10 is over 20 basis points, whereas just 4 months ago, the 2-year was yielding higher than the 10. So this week, again, this is another shortened week with New Year's. So on today, we have the pending home sales release. It's expected to be at 0.7% versus being up 0.2% in October. So for November, again, expectation positive 0.7% expected. Jobless claims, which came in lower than expected last week at 219,000. It's expected to tick up a little bit this week. That'll be announced on Thursday. It's expected to be 224,000. And lastly, on Friday, the ISM manufacturing is expected to come in at 48.3 for the month of December. It was 48.4 the month before, so virtually no change. Now, that index, as I've mentioned many times, is scaled at 50. So anything over 50 suggests expansion in manufacturing in this case. Anything below, contraction. We have been under 50 for the better part of the last 2 years. So manufacturing, while the service economy is doing well here in the U.S., manufacturing, not so much. So that's it. We thank you very much for your attendance today, and at any point this year that you have joined us, we'll look forward to doing this again with you next year. Thank you very much. Have a great day.